These VA loan mistakes cost veterans thousands of dollars. But today, we're going to talk about how you can avoid them. Purchasing a home is a pretty complex process. There's a lot of moving pieces, and it's important to understand your left and right limits and the things that you really need to do to make sure that the transaction works out in your favor and that you're not inheriting any problems with this home or the property itself. And unfortunately, a lot of people will skip steps or underestimate the importance of certain aspects of the transaction, and it can end up costing them a ton of money later on. And usually these people will come out of the other end with a really poor outlook of home ownership, but honestly, usually it could have been avoided. So let's get into this stuff today. Mistake number one, spending too much on that first house. Now, this is what I mean by that. For most people, the first home they purchase is not the forever home or even the 10-year home. It is the first home, the starter home, whatever you want to call it. And the reason I say that some people go way too hard on that first one is that they'll eventually say, well, we'd like to keep this as a rental, turn it into an income producing property, which is fine with the VA as long as you met the occupancy requirement. But as we know, because you watch my other videos, there is a limit on how much you have to work with on your VA entitlement. And what I see a lot is they want to buy that second home, which is usually an upgrade from the first one, am I right? But they only have a little bit on their entitlement. So here's an example that I actually came across quite recently. So they were in a normal area, which means that in 2026, their VA entitlement was worth $832,000. They spent $400 on their first home, which they only lived in 2 years. They kept it as a rental, or at least they wanted to. But if they spent $400 on that means they only have $432 left on their entitlement before they have to start coming out of pocket. Well, the next home they wanted was, again, an upgrade and in a more expensive area, and it was about $740,000, which means they had a shortfall of a little over $300,000. Now, again, since you watch my other videos, you know that they would have to put down 25% of the overage. So we're talking a down payment was roughly like $77,000. Clearly, that's very, very spicy. Now, how this could have been avoided is maybe if they had just made some concessions on that first house and not chewed up quite so much of their entitlement. They made it work, but it cost them a lot of money to do so, and they kind of wish they had made a different decision with that first home. Mistake number two is forgetting or not really understanding the VA funding fee. Now, the VA funding fee, unless you have an exemption, is the surcharge from the VA that keeps the program going. If it's your first time using the VA loan, it will be 2.15% of the loan amount. Every subsequent usage is 3.3%. Right? This gets baked into the loan. So when you are pricing out homes, whether it's on your own or with your lender, you really have to make sure that that funding fee is accounted for, because it could add $5,000, $10,000, $20,000 to the loan balance. Unfortunately, when a lot of veterans and service members are pricing out homes on their own, they omit this so that their calculations for the monthly payment ends up being a lot lower than what it really is. You can't do this. Please do not forget about the VA funding fee. Number three, the dreaded choosing the wrong lender. And I'll just use an example from just the other day. Unfortunately, they came to me too late for me to help them, but they had a loan estimate, as a closing disclosure actually, from, of course, Veterans United, and it was for 6.125%. The charges, the lender fees between origination and points added up to about $4,700. And this home was priced somewhere around $250. So, almost 2 full points worth of charges. I ran my pricing, and I had the unfortunate distinction to tell them that I had them at about 5.9 for absolutely free. So I could improve the rate a little bit, but who cares about that? The cash to close would have been close to $5,000 less. And when you look at their disclosure, their out of pocket at closing was a little over $4,000, which was entirely fees driven by the lender. They just took Veterans United's word for it. If they had maybe shopped around just a little bit more, they could have gotten themselves a much better deal. Mistake number four, skipping the home inspection. Oh, this one drives me crazy. And occasionally I'll come across a real estate agent that's advising the borrower to skip it to make their offer more competitive. No, the VA does not require a home inspection, but you should never, ever, ever skip it, even if that home is new construction. All right, the inspector is a third party that works for you, and that is your insight into the true condition of the home. They will give you a 70 or 80-page report full of information, the good, the bad, the ugly, permitting information, age of the major end items. It is really, really important information. And yes, they can find a lot of things that are presently wrong with the home that you can negotiate with the seller to have repaired before you take occupancy. Some of the most catastrophic post-closing issues are things that could have been found during a home inspection if the buyer had elected to have one done. Mistake number 5, refinancing at the wrong time. Look, I say it all the time, mortgages is a predatory industry, but it's never worse than during a refi boom, right? And you've probably experienced it if you ever purchased a home. You'll start getting the mailers saying you can get a rate of 2.5%. You got to call me right now at this random 1-800 number. You'll get the unsolicited text messages, the unsolicited emails. I mean, come on, we've all experienced it. And 99.9 times out of 100, this is all bait and switch. They're floating these really unrealistic terms in front of you in order to get you on the phone and get an application and get their hooks in. And then you'll start to see the real terms, which are nowhere near as good. And the reason I say that the timing can be really bad on a refinance is you have lenders that will try to refinance you every 6 months. And it's just not worth it because there's no free refinance. Like, those costs are being lumped back into the loan. So there was a borrower I talked to a few months ago that had fallen into this trap. And they showed me like the closing disclosures from all 3 refinances that they had done over the previous 18 months. And you just saw their loan balance increase. And by the end of the third refinance, the loan balance was like $12,000 more than it was when they bought the home. They had gone completely backwards to save money. So when you are talking refinance with a lender, make sure they're breaking down the ROI, the break-even point, all of that to make sure that this is really what the VA would call a tangible benefit. I'll tell you from experience, 70% of the time, the benefit is not there unless rates have really improved over a fairly short period of time. These are the 5 mistakes I see quite often that cost veterans thousands and thousands of dollars. If you have questions about any of these or anything else about purchasing a home or home ownership, please reach out and we'll set up a phone consult.